Okay, so Chapter 7, we are going to learn about securities analysis, the process, understanding the purpose of doing economic analysis to help us understand what stocks to buy. We're going to talk about different industries, what an industry is, how they can help us to invest, and we will talk about the basics of fundamental analysis, why it's used, how it can help you. Having a problem paging down here. There we go. We're going to calculate some financial ratios and think about financial statement analysis, and try to gauge the value of a company and if it's a good company to invest in as well. We'll talk about financial measures, what's the best way to assess a firm's performance, and just talk in general about the valuation of a company. What is it truly worth? Because oftentimes the stock price is nowhere near the true valuation of a company. So this process is about gathering information regarding your company, putting into some systematic, logical framework to think about what the true value of the company is. So you know what the market is valuing the company at, but that's just really a guess. And oftentimes the valuations can get to a point where they're not even close to where the company should truly be valued. And you might see that Candyland Crush should really be valued at $4 a share, based on its future potential of eventually people are going to get bored playing King. Well, it's King there's a company. They might get bored of their signature product and move on. Something else will come along that's hot. Just like Farmville was hot, and then that was like 8 years ago, whatever. And then something new comes along. All right. So intrinsic value is really trying to determine the true value of a stock, and there's no one formula or process that we could say this is how you do it. It's a combination of understanding different tools and techniques and measurements and experience. So you use your experience, what's worked for you, what you've seen is accurate, and you marry it up with different metrics to come up to a valuation that you feel is as close to accurate as you're comfortable with. And then you look at the real price. So if you feel that Yelp is a $150 stock and is currently trading at $86, then you buy it if that's your valuation. So there's things we can do that help better judge what the intrinsic value of a stock is. And that's really what this chapter is about, trying to figure out what can we do to better our odds in picking a stock that's going to make money. So it's going to depend on some of the things that definitely future cash flows is the most important factor in the valuation of any company. So who's going to have a more consistent future cash flow? A company like Zynga that makes Farmville, or Facebook? And I would say Facebook. That's what I would feel had more consistent cash flows. A company like King, which makes the Candyland Crush, or Microsoft. And of course, Microsoft would have better cash flow. So discount rate and the amount of risk are also a factor. The riskier, like those online gaming companies, are risky because the new hot game comes along and it's very, very difficult to develop an Angry Birds. So once you get an Angry Birds type of game, you make Angry Birds 2, Angry Birds Star Wars, Angry Birds Indiana Jones, Angry Birds for kids, Angry Birds with pigs. You just keep beating that horse until it's dead. Because it's much easier to get profits out of that than to try to develop a new hit game. Once you have a hit game, you do have the advantage of trying to steer people towards your next game, and you'll see whenever you're playing these games, there'll be advertisements and commercials or bonuses if you join this other game. So they have that networking advantage, but it's very difficult to put a value on a company. And I would say that these companies should look at Activision, Blizzard, EA. Some companies have been around for years that make traditional video games, to see how they did it. And a big way that these companies were able to supplement their income and cash flows is to do licenses. So if you're Activision, you're licensing Spider-Man and you're making series of games of Spider-Man or Batman for another company, and that helps to keep your cash flow a little bit more predictable and your stock price higher. Okay. All right, so here is the traditional approach to securities analysis. Is step one, we see where we are in the economy, and that's going to help decide whether or not we're going to be buying or selling stocks. And then step two, we do an industry analysis. The basic concept here is if we know an industry that's a good industry, we want to find the best companies within that industry. So if we look at apparel retail, we want to look at all the companies that sell clothes, and which 2 out of the 13 companies do we feel are the best companies or have the most value, their price compared to their intrinsic value. And then step 3, the fundamental analysis, which is looking at the specific companies probably within that industry. So you could pick one industry that you think is going to be good moving forward. Maybe it's biotech. And then in step 3, the fundamental analysis would be to look at every company in the industry so you could pick out the ones that you feel have the better chance of making money. So if you had an industry you know is going to be good and has 200 stocks of that industry, and you can throw out 50 stocks that are clearly the weakest, you'd have a much stronger return than the index of that industry. Even if you took the S&P 500 and you took those 500 stocks and you got rid of 200 stocks that you felt were the weakest, companies with the least amount of future potential out of the 500, and you just kept the core 300, you could probably beat the S&P 500 index if your judgments were on spot. Now, one thing that we have to be aware of is that the markets are efficient. So you have millions of investors buying stock every day, buying and selling stock every day, doing all this analysis, making a judgment. It's overvalued, sell it. It's undervalued, buy it. So you have all these different individual minds reviewing and looking at stocks. So the idea is that the price the stock is currently trading at should be efficient and should be accurate. So we believe that if the more efficient that we believe the market is, the smaller the price inconsistencies or the mispricing of the market will exist. So in a truly efficient market, you would say that there's almost no point to figuring out the value of anything or the intrinsic value, because everything is trading close to the intrinsic value if you believe in a very efficient market. Now, most people believe that the market is efficient, but there are points in time when the market becomes inefficient, such as a bubble. So a bubble is a prime example to say the market's not always efficient, because at some points in time, the valuations get way out of control. So in those rare times the market isn't as efficient as it should be, there are some opportunities to make some money. There can be pricing errors. There could be things about a company that the market or Wall Street hasn't realized. There could be, for example, Facebook buying Oculus Rift. People may not really understand that technology and feel that the $2 billion paid is way too much. But if this is going to turn into a $20 billion a year industry and revenues for selling these and selling games related to this and royalties of it, it's going to look like the smartest purchase ever. When Google purchased YouTube, it was criticized for the amount of money they paid for YouTube, which at the time was an all-time record amount paid for an internet company like that. But today, Google has made that investment really pay off for you. The YouTube and the advertising in YouTube is a significant contribution to Google's profits. So investors may have punished Google stock the day they spent the money to buy YouTube, but in years later, they've proven that that was the right price, or even a better price than most expected, and their return on their investment was significant. So, and one of the reasons we feel that the market is mostly efficient most of the time is because there are tons of trained and many investors using fundamental analysis to keep it efficient. So when things do get out of control, there's generally a period where it becomes corrected. Now, the thing that can influence the prices of stocks significantly is the economy. So if the economy is doing well, the stock market will do well. And if the economy is doing poorly, the stock market will do poorly. And it makes sense because in a poor economy, companies are having less profits, they're disappointing investors, and stock prices go down. And an expanding economy is just the exact opposite. So stock prices are generally heavily influenced by the state of the economy. And the business cycle has a huge effect on most companies' profits. And we talked last time about companies that were defensive and cyclical, and each company has a different relationship to the effect of the economic cycle, and some companies are less affected by it than others. So that's to be taken into account. Now, key economic measures that you should know as an investor, and makes when these are announced, the markets generally move significantly, especially if there's a surprise. If the number comes out that people have expected, that's already built into the market. So if the number is published at a significant difference to what's expected, then we have huge volatility in the marketplace. So gross domestic product is measuring the overall value of goods and services in the economy, and is what we use to sort of gauge whether or not the economy is growing. So if this number comes in line and it meets expectations, there's not going to be too much of an effect in the stock market. But if the number comes up and suddenly it's much lower, we expected 2% growth and we have a negative 1% growth, that could drastically change the value of stocks in the marketplace, especially those turning points when the market's going from expanding to contracting or contracting to expanding. You could see significant changes in stock prices the days and weeks after that's announced. Now, industrial production is looking at the activity in the output of industries as far as the productivity segment in our economy, and we're looking to see generally are industry producing more goods and services? Because if the industrial production is ramping up, then that means consumers must be demanding more goods. So if sales are escalating, that's going to channel back to the companies, and they're going to increase production to meet them, especially in automobiles. So if automobile sales start to take off at the dealerships, they're going to quickly build that into the models and forecast even more production of even more cars to make up with the demand, because they have the turnaround is critical here, because you want to get those cars. You don't want to run out of cars in time to meet the demand. So that's a key component. Now, things that can affect the business cycle is definitely government. So right now, the government, we have a couple of issues here with our government that's affecting the economy right now. One is that we have a huge deficit. And so that is causing the government to be concerned about spending and sequester and cutting spending. And we also have taxes, which when the taxes are raised, that money may help solve some of the debt management problem and the budget deficits, but it also puts a drag on the economy as more of your dollars go to the government and less for you to consume and buy things. So the government can also, through the Fed, affect the monetary policy, the money supply, through all these quantitative easings that they've done and different amounts. They got all the way up to $85 billion, and now they're pulling it back as they're tightening it, as they called the there's a name for it. It's not what is the name for this? The Fed is doing, and there's a reducing the trimming, or no, what was that? There's a name everybody says when they're cutting back the stimulus. No. Hold on a second. Tapering. That's it. Thank you. I was calling it trimming. I had a tip of my tongue. Tapering. So as they taper the money, the Fed can create or destroy money, and that's going to affect. The more money you push out into the economy, the more it stimulates the economy. For example, one quick example. There's a show that used to be on, maybe it's still on, called Survivor, and they torture these people on an island and they starve them and they make them do all these challenges. And one day they'll give them all $4,000 each, and then they have to bid on 5 potential meals that would normally cost anywhere from $20 to $40. But the bidding gets into hundreds of dollars because they have a lot of cash and only a small amount of food or products to buy. So if you put a lot of money out there with only a small amount of products to buy, the prices go up, and that's what inflation is. There's more demand for fewer goods. So that's what the government's trying to do, because that, until inflation develops, it's going to stimulate the economy and pick up the slack of production that may have drifted lower. So that's one thing they're trying to do. And as now they're pulling that back because it's worked. The economy has expanded, and employment has gone down, GDP has gone up, and they're trying to reduce the money supply, or at least reduce the expansion of the money supply to keep that in control, because now they're afraid if they overstimulate, they can get inflation. And inflation is a really bad thing. And that leads us to other factors: inflation, consumer spending, business investment. So the amount that consumers spend is going to be affect the business cycle greatly. And as people feel more confident, I got a job, or I can get a job, or there are plenty of jobs, and I'm making money and I'm doing well, I'm going to buy a car, a boat, a house. I'm going to buy everything, because we are a consumer society. Now, if businesses feel that consumers are purchasing, they may have to make some business investments to expand their facilities, make new locations, better factories, hire better equipment. Also, foreign trade and foreign currency exchange rates are going to factor in on how business expands and develops. Obviously, the more open and the more access you have to foreign trade as a country, the more your companies are going to sell products and generate more profits. All right. So some other key economic measurements that people who buy stock keep track of is they like to look at an index of leading indicators, and this is a bunch of indicators sort of put together in one index that's looking at indicators that are predictable, that help predict the future of the economy. So the index of leading indicators is a good way to get an understanding of, is the economy going to expand or contract in the months ahead. Personal income, if people are getting raises or figuring out ways to make more money, either through promotions or self-employment, that's going to do well for the economy. Retail sales is a big number. We like to see that consumers are spending and buying. The money supply, which you previously talked about. Consumer and producer prices. This is a gauge or measurement of future potential inflation. Unemployment, and unemployment is something they're really focusing on now because unemployment is dropping. And if unemployment gets too low, the Fed raises interest rates to prevent inflation. Because if unemployment gets too low and there's too few people and too many jobs, they start raising the starting salary of these jobs to attract people from other companies, or can create a huge wage inflation. So they'll raise interest rates to help reduce, slow the economy down, to reduce, to increase unemployment, to balance out this inflationary effect. Housing starts, how many new houses are constructed is a big number. If we're constantly improving this, it's a huge stimulus to the economy, not just in the building and the construction side, but also once you buy a new house and you move in, it doesn't come with furniture or dishes or rugs or all these things you need in your house, and you have to go and buy all that. So it stimulates consumer spending as you buy your dishes and your rugs and your couches, and your sheets and your beds and your dressers and your lawn equipment and your lawnmower and the seed and your plantings. It just never ends. If you own a house, it's just money, spending money all the time. So if you could live at your parents' house for longer, do it, where you don't have to pay for such things. All you have to do is take out the trash or clean the pool. It's a great deal. And if you want to move out, let me know. Maybe your parents will let me move in. They're nice parents. Accuse a vacation from doing all that work. Okay. Let's move it along. So growth in GDP obviously is going to be a positive impact for stocks. Industrial production and continued increase is also good for the stock market. Inflation is horrible for the stock market. We don't want inflation because that means the Fed's going to raise interest rates and then the business activity will slow down. So inflation is very bad for stocks. Corporate profits, higher corporate corporate profits are obviously good for the stock market. Increasing unemployment is bad for the stock market because if more people are unemployed, they're going to buy less, your company is going to make less money. Federal budget surplus is good for the stock market. It's good for interest rates and stock prices. So if the government actually spends less than they take in, that it makes people feel more confident about the government, more confident about the dollar, more confident about the possible tax decreases. A weaker dollar, it depends. If we have a weaker dollar, then foreign imports become more expensive for us, and that can kind of be an inflationary pressure. But our exports become cheaper, so a weaker dollar will make our exports cheaper. So it's a plus, and you just don't want it to get too weak too quickly or too strong too quickly. So slower movements, but generally a small weakening of the dollar is not going to be a big issue, but a sharp weakening of the dollar could be negative for the stock market. Interest rates, rising interest rates are bad for the stock market because interest rates go up, your credit cards and your car loans and your mortgages go up, and business loans go up. It's going to slow the economy. And of course, money supply, a slow growth of money supply has an impact because it allows the economy to grow larger, but any excessive money growth is going to be inflationary. And that's what the Fed is worrying about now. They want to trim that before it becomes inflationary. Now, where to get this economic information? There are plenty of websites and magazines that will publish this data. And if you belong to any news feeds and you put in economics in your, I guess, in Reddit or Zeit or something like that, they'll generate a bunch of articles and information, the latest. Even Yahoo Finance talks about whenever a new financial economic statistic is released, they'll discuss it and discuss the impact on the market. And it's sort of the experience. As you get used to living through some business cycles and seeing the ups and downs of the stock market, you start making experience and connections and understanding how certain stocks react in different ways during changeovers between expansion and contraction of the economy. So you need to really experience 2 or 3 of these in your lifetimes, expansions and recessions, to really get to understand the experience of how stock market and individual stocks are affected by this and make you a stronger trader. So it may catch you off guard in the beginning when this starts to happen, and some unexpected things may occur. So it's the experience that helps a trader get through the changing of the business cycle. Now, when the economy does change, we can use this to figure out what industries are going to benefit and what industries are going to be hurt. So, and what industries really won't be affected as much, I guess you could say also. And then we can look at the individual companies within those industries and see how sales will go up or down. For example, we have a big recession, and during the big recession, sales at a higher end franchise like Cheesecake Factory go down, but sales at a lower end fast food restaurant actually go up as more people trade down from Cheesecake Factory and will go to McDonald's. So some industries may have little, no, or a slight improvement based on a contracting economy, where other companies, especially luxury companies or companies that are selling big ticket items or expensive items, may have more of a significant downturn. So this is why we want to look at the industry and then the individual companies within the industry to help us use the economic outlook to help us predict stocks. Now, something interesting is stocks change before it's generally recognized the economy is changing. So before a recession, stocks will go down significantly before a recession, before anybody knows we're in recession, because the individual traders sense it, feel it, understand it, and they're getting out of stocks while the getting out is good. So stock prices tend to be a leading indicator of the direction of the economy itself. Although some may argue it's sort of self-fulfilling prophecy. Stocks go down, so people feel poorer, so people feel like something's going on, and they pull back on their spending, and they create the recession just because the stock market went down. So no one's really sure, though. Now, the next step would be industry analysis. So this is where we would try to pick out the individual industry that we'll think will have say we're in an economic expansion, what industry is going to benefit from that the most? So if you're at the beginning of an economic expansion, usually the semiconductor industry benefits, the automobile industry can benefit a great deal. So there are some industries that lead the forefront, they get the most impact early on in the economic expansion. So you may want to look at those industries for new opportunities or potential growth industries. And then of course we're going to go inside that industry and look at the stocks that are going to be the most have the most benefit or potential. So we're coming up on the new cycle of the game consoles, PlayStation 4 and Xbox One. I wonder if the next Xbox will be called Xbox 2. I don't understand the numbering. We went from 360 to 1, but either way, which video game producers, and we have a few of them like Take-Two and Activision Blizzard and Electronic Arts, and a few others, which of these companies will really be in a position to profit the most from these games? Or will the next generation of people shy away from these big amounts of spending on these consoles and just drift more towards the casual games of Facebook and iPad, the games you can buy on iPad and Android tablets? Would that be where more people are moving towards? Because as those tablets become stronger, they can handle more complex and more advanced graphics. So maybe some people will say, I don't really need a new console for $700 because I get all the gaming I need out of my tablet. These are just things that, as a trader, you're going to start asking yourself, is there a shift in how these things are purchased? Because if you think about it, some people, not everybody can afford everything. So you may make a choice, or your parents may even ask you, you can either have a PlayStation 1 or a new iPad Air. Which would you rather have? And for some people, if they only have to choose one, they may choose the iPad Air because it could be more. It's more versatile in different ways. So things that can affect the industry is the nature of the industry itself. Technology industries are generally pretty fickle if a new technology comes out. For example, a better example might have been the tablets are coming out and reducing the demand for laptops. Or just like when laptops came out and reduced the demand for desktop PCs. Now that you have a tablet there with even a keyboard, do you really need is there anything a laptop can do that can't do? Right? Even if you have an iPad, you can get a keyboard for that. I see plenty of students with that. And that they're releasing Microsoft Office on iPad, so more and more functionality. Okay. The government regulation industry is a big factor too. How much is the government going to get involved and impose more requirements and regulations that could weigh down the profitability? What role does labor play? If you're, say, the automobile or airline industry, labor is a big part. You got your flight attendants, your baggage handlers, your pilots, your co-pilots. They all, if they have strong unions, they can demand more money, and that can be effect on the industry. How important is technology developments within the industry? So if we're talking about the video game industry, and we were talking about the Oculus Rift earlier, and that could be the next real have-to-have device. I mean, if you see how this works, you put this thing on, and the latency is low, so you move around, and it's just like you're in a real world. And that's why people who are prone to motion sickness, the motion going on in the world is so realistic that it's sort of like the first step to the matrix, I guess. How important is that technology? If you're a developer like maybe Nintendo, if they don't have a system that's going to have one of these virtual reality interfaces, will they still be around? Economic forces, how they impact the industry. So, interest rates are going to impact the housing industry and the automobile industry a lot faster than some other industries. And then also the importance to financing the company, how much financing is the industry relied upon, and in certain respects, when the automobile industry got into trouble, they had to get bailouts from the federal government because their access to capital was so severely tightened. All right. So if we're looking at growth cycles of an industry, so in the initial development, say like that new piece of virtual reality technology, it's risky, the risks are high, a lot of money can be spent, but if it's proven to be something society wants to purchase, we can get a rapid expansion. Do you remember a time, maybe when you were younger, when there were no high definition TVs? You had to have that sort of TV that was a big box. Maybe you probably remember these when you were younger, or maybe you still have one if your family's very not so wealthy. Or maybe you got the leftover TV set in your room and the living room got the new HD TV. So there's been a rapid expansion in people having HD TVs. So now we're almost in a mature phase where most everybody has one now. Now the declining market would be the old Cathode ray tube TVs, the big TVs. Those it's pretty much dead. I don't think they sell them. Not in this country anyway. But that market, just like if you look at the DVD market is being taken over by Blu-ray, and eventually DVDs will be completely gone, and Blu-ray will just be Blu-rays. And they're actually coming out with a new technology soon that may eclipse Blu-ray. So everything, industries and products go through this cycle. And why this cycle is important is because as an investor, you want to be sort of right before rapid expansion. So you want to get in once the initial development is done, and it seems like a great product, and you want to get in. That's sort of like Facebook did when they bought Oculus Rift, is they got in before the rapid expansion because it's clear that this technology is something everybody's going to want to experience and own. So they're getting in before the rapid expansion, as is Sony with their development. And this, at a certain point, is going to be like the Kinects. Remember when the Kinects was new? I guess Nintendo came up with it first, the motion sensors, and then that was new. It rapidly brought Nintendo back as a company, and then Microsoft got their Kinects, and to a lesser extent, the Sony motion. I'm not sure that one I hear is not as good with the things with the ball on top and you have your hands. But that's standard now. That's been matured. Pretty much everybody who has the system is going to get that. Now so if you find a company that is going to develop a new product that you recognize ahead of most people that this is going to be the hit product, you want to get in and buy that company before everybody else realizes it. Just like you should have bought Apple when you realized that iPods were going to be big or were getting big, and there's going to be a rapid expansion of people buying iPods, and they parlayed that into iPhones and iPads. Next up is the iWatch and the iTV that they're developing. They just had a big deal or working on a deal with Comcast. So, all right. Sources of industry information. Of course, these different trade journals and publications will help you understand, as well as just basic searches online will help you understand what industries there are, what companies are within those industries, and such. Okay, so the last step would be the fundamental analysis. And here is where we actually look at the individual companies. So for each specific company within the industry, we want to know what's their competitive position within the industry. What is their growth in sales and their sales potential, their profit margins, what are the dynamics of their earnings? When I say dynamics of earnings, I mean, are they all from one Candyland product? I'm sorry, I keep saying Candyland Crush. It's Candy Crush. Thank you for not correcting me on this. Candy Crush. Candyland is a game I played as a child, although they should make a game called Candyland Crush, or maybe Candyland Smash, or whatever. Sort of like when Flappy Bird was big and that went away, you came up with Floppy Bird and Flappy Dog, and, I digress. But anyway, you understand what I mean. If a company has a more dynamic and varied amount of sales from multiple products and multiple streams of revenues, it's more balanced. We also want to look at the mix of assets, cash, accounts receivable, inventory, their financing mix, how much is debt, how much is equity. To help, this will influence how you value the stock. And the performance of the stock is going to be what's at the core center of this fundamental analysis is the company performing better and do they have better future potential? So where do we start? The first place for this, unfortunately, is financial statements. And most people are not accountants. And most people have a hard time interpreting and reading financial statements, let alone creating them. I know firsthand, starting out my career, actually creating them by hand, and later with computers. They are a pain. There's a lot of specific details and laws and regulations, and and decisions companies can make to craft and develop their financial statements. And companies can be tricky about how they portray their financial information in these financial statements. Now, financial people and investing people like to use financial ratios because it's a shorthand, a shortcut to understanding financial statements, and specifically looking at financial statements between multiple companies, because the ratios will be standardized where different companies' financial statements won't be, because different companies are at different sizes. So financial analysis can be very demanding and time-consuming part of the stock selection process. So this is the part where you really roll up your sleeves, you let your financial accounting class do its work, and you start taking a much closer look at the company's financial statements. Now, the financial statements are, one very important financial statement, of course, is going to be the balance sheet. And we're going to look at the mix of assets, liabilities, and equity. So this is important because you don't want a company to be all debt. You want to have a company to have a healthy mix of generating wealth and spending that wealth on assets and retaining the equity. Okay, and I guess we're definitely looking for a trend where the company is generating wealth, retaining those earnings, and buying more valuable assets. It's sort of like if you were, there could be someone who appears to be very wealthy. They drive a very nice car, they have a very big home, and they have very nice clothes. But if you scratch the surface a little bit, you find out that the clothes are all purchased on credit cards, the car is a lease, the house, 90% of the bank owns the house, and they have $40,000 in credit card debt. So even though they look like a very wealthy potential person maybe to date, wow, I'd like to date this person, they have a great lifestyle, look at all the stuff they have. Then you find out it's all a house of cards. So maybe you want what they call the millionaire next door, right? Ever have a next door neighbor? He looks like he wears clothes that are old, his car is old, he still cuts his grass himself, he doesn't have a landscaper, but if you were to look in his bank account, you see he has $2 million in his bank account. And you say to him, how do you have $2 million? You look like shit, And then you find out that, I don't waste money on getting, manicures and haircuts and new clothes and new cars. And, I save all that money. My house is paid off. My car is paid off. I don't have big monthly bills. I don't have cable to worry about. I just steal your internet access because you don't have a security password. Okay. I remember I lived in an apartment complex many years ago, and when I first had the wireless, I was one of the first people, early adopter. I didn't have the password on it, so other people were stealing it. So then I made the name of my, you can name your wireless account, so I named it $10 for my access code or something like that for my password per month to see if anybody would want to pay me that, but. Some people questioned it. No one paid me, but they're like, more of the question was, why did you put a password on it? Okay. So this is an example of a balance sheet. You've been familiar with this. You've had classes where you've talked about this. We talk about balance sheets in financial accounting and finance, so it's nothing. I don't really need to go into very deep specifics. Now, the income statement is even more important because here we're looking at profits. Revenues, expenses, and profits. So we want to know how much money is a company making or losing. And revenues, we like to see an increasing percentage of revenues. Revenues are constantly increasing at a strong percentage. That means your company is growing. Consumers like your product and they're buying more of it. And we like to see that you're keeping your expenses under control, such as labor and materials, and that you're good at making a profit. That you can turn your sales, your revenues into profits. Because you can have a company with $10 billion worth of sales, but if they're not making any profits, what good are they? You can have a company that has only $100 million in sales, but they may make $40 million in profits with a high enough profit margin. That's a company you want to own. So it's not necessarily the number one in sales, but if you can get the dual of good profit margins and increasing sales, then that's the company you want to own. So in the income statement, we're looking for these relationships between expenses and growth. If the company, some companies, if they grow any more, the expenses are going to explode, because they have to buy a new factory, or they have to, start paying their employees more money to work more overtime. So you want to look at these both for the income statement and the balance sheet. You want to look at the trends. Is the company improving over time? Sort of like your report card. If I was going to look at you and judge you for getting into a graduate program, I would want to see that you're going from C's to B's to A's to continuing A's by your 4th year, that there's an upward improvement. You're continuously improving your grades and your ability, or certainly we want to see that you're not pulling back. Okay. And here again is an example of an income statement, but you should be very familiar with this. Okay. So the cash flow statement is even more important because the cash flow statement keeps it real. And in the cash flow statement, you can't play any games like you can in the income statement. So companies actually play games in the income statement to lower their profitability because they're trying to reduce their taxes. But the cash flow statement shows you exactly what cash is coming into the company, what cash is going out of the company, and what's left over. And what we're looking for is that the cash generated by the company is coming from renewable, organic, or operational sources. A cash flow could look good, but that would be, example, you could have a cash flow from working a job and from interest you get on savings bonds. So you may have a cash flow of $2,000 a month, and that's good. Your cash flow may also be $2,000 a month, but that cash flow is coming from cash advances on credit cards, student loans, and things of that nature. So it depends on where this cash is coming. If it's coming from a source that you're generating and don't have to pay back, that's stronger and a better company to invest in than if the cash flow is coming from continuously borrowing money. And some companies, in the beginning, they are borrowing a lot of money before, even at the time they go public, and that's not the best source of cash. So you want to really pay close attention to where the cash is coming from, and then also how they use the cash. If a company's generating a lot of cash, are they reinvesting in the company to further expand their sales, their potential? So we're to keep some common themes today. Facebook used their cash to buy Oculus Rift, and if you look at Cisco, Google, Facebook, Microsoft, in the past or in the present, they've been using significant amounts of their cash to buy other companies to help them to expand. Or in Microsoft's case, they use a significant amount of their cash to start the Xbox One, which was a big losing turd for a while of a company before it started to make profits. When Xbox first came out, it wasn't profitable really to the 360. Became the first time Xbox was super profitable. But they had the cash and the time to do it. And that's why you don't see a lot of companies creating gaming entertainment systems, because they are so expensive to design, develop, sell, and then get to a point where enough people have them when you start making a profit on selling of the games. All right. So here is a basic cash flow statement. You get cash flow from operations, from financing, and from investing. Your 3 potential sources of cash flow. And so some cash flows are better than others. So that's why we want to investigate, where is the company generating the cash from. If it's all from borrowing, we don't like that as much if it's from operations. Now, other sources of financial statements. The company's annual report will have all the financial statements we talked about it, plus more. The company will also file 10Ks and 10Qs, which are more timely than the annual report. The Securities and Exchange Commission has a website where you can go and find their company's filings, and also the S&P Standard & Poor's has reports on companies. The internet has plenty of financial portals to go to get financial information. Hoovers.com is also a great website. And as a Stony Brook student, if you use this site on campus, you have an upgraded membership to get and download financials from companies. Okay. Now, the financial ratios are what we're going to use to really look at and dive in a little bit deeper onto the company on multiple levels. So we're going to study the relationship between these financial ratios are an expression of the financial statements, which will give us an idea of where the company's going, what they've done successfully and where they're going, give us an idea of how they manage their debt, how they manage their assets, how their stock is performing. So it's sort of like a quick guide to how the company's doing. So when you get these financial ratios, you don't have to read 60 pages of financial reports. You can just get one sheet that has their financial ratios, and if you look at it in relationship to other companies or in relationship to their ratios in the past, you can get a quick snapshot or an idea of how the company is doing compared to itself year over year and also compared to other competitors. Now, if we're going to have 5 major groups of financial ratios, one we'll call the liquidity ratios, which looks at their cash to debt, how much money they have in a temporary sense compared to what they have in a longer term. So liquidity, the basic concept here is cash versus obligations like accounts payable, things of that nature, bank loans. So we want to see the more current assets they have over their current liabilities, the more liquid they are. Activity ratios, managing how well does a company do at managing its assets. Did the company overspend? So you could have a good example is you can have an ice cream related company like Red Mango, and it has ever been to a Red Mango and they have all those big machines to pump out all the ice cream or frozen yogurt. That's a lot of assets to have to open up a Red Mango. You can open up a Ralph's Rotten and just have a couple of refrigerators with tubs of ice cream or ices in it. That's a lot less expensive to open up. So their asset activity at Ralph's Ices, Ralph's Rotten's the nuts and candy store, Ralph's Ices or whatever, and that store actually, I think they close in the winter, right? They don't run them year round because the assets aren't productive in the winter. So they rather just absorb the expenses and operate the store in the warmer months in the north here. Leverage assets, looking at how debt is utilized in the company to buy assets, profitability ratios, and then common stock ratios. So each of these we're going to talk about. We've talked about them before in other classes, but here we're going to talk about them specifically as they relate to investing. Okay, so let's start out with the current ratio, and this is a liquidity ratio, and simply current assets over current liabilities. Now, the higher the ratio, the more liquid a company is, and the more liquid a company is, the less risk there is. So in a stock purchasing point of view, companies that have more liquidity are less likely to go bankrupt. And if a company goes bankrupt, generally the shareholders lose everything. So that's why this ratio is important. So again, the higher the number, the better. Now, net working capital is not so much of a ratio as more of a dollar amount number. And we're looking at current assets minus current liabilities. So this just gives us the dollar number of hopefully positive of the assets minus the liabilities. And the bigger the working capital number, the more money they have to work with as a company. So we generally are only worried when this number is going down consistently. So operating with a small amount of working capital can sometimes be difficult for a company. So we keep an eye on that. I wouldn't typically say that was a ratio, but it's something that's commonly talked about. Now, accounts receivable turnover is looking at sales and specifically credit sales divided by accounts receivable. So what we want is a high ratio here. So we want the, this is sort of a multiple. So if we had, say we had $120 million in sales, $120 million in sales, and we had $10 million in accounts receivable. That we would have accounts receivable turnover of 12. It means that we collect our money pretty fast. If we had $120 million in sales and $120 million in accounts receivable, we'd have a turnover of 1, meaning that we didn't collect any money. All our sales are still in accounts receivable waiting to be collected. So that's very inefficient. So the larger this multiple is, it shows that the company does a good job at collecting their accounts receivable and lending money to people who will pay them on time and pay them back. So that's why this is important, because it shows the credit consistency and the credit value of a company. Now, why we look at it between industries, because some industries have different forces that can give different averages. So you can't really look at an automobile accounts receivable turnover compared to a fast food restaurant's accounts receivable turnover. Yeah. Okay, inventory turnover. This is looking at sales to inventory. And this, again, is sort of an activity ratio where if you were, think of it on a personal level. If you eat one box of cereal a week, and so your annual cereal purchases are 52 boxes of cereal, and if you had 52 boxes of cereal in your house, and you consume 52 boxes of cereal, your turnover of cereal would be 1. Very inefficient. Can you imagine storing 52 boxes of cereal inside your house and just buying that once? It would be efficient because you buy it once a year, maybe from Costco or whatnot, and then you're done buying cereal for a year, but you're spending all that money up front. The cereal is expensive. You could easily pay $4 a box. So you're talking about $200 plus dollars. Now, if you were just to buy and hold one box of cereal a week, now you consume your annual sales would represent your consumption of cereal of 52 boxes, but you only have one box currently. Your turns are 52. So you can see that's more efficient for you. You have one box to worry about. You buy it once a week, and you have one box to store. So you're a lot more efficient in your turns. Now, if you were to extrapolate that to every food item in your house, and you were going to buy every food item you need for the next year on January 1st, that's ridiculous, right? It would be very inefficient, ridiculous. Most of it would spoil. So it's the same thing with companies. They want to be able to maintain a small inventory in relationship to their sales. That's why in today's world, I think only you and me may remember that most stores used to have what was called backup stock. So you go into a store and half of it would be warehouse, and you say, oh, do you have any more of these left? They still do this with shoes quite often. And they'll go, oh, let me check in the back. And they come back, oh, yeah, we have about 40 more of them. Let me go put it on the shelf. Now, in order to reduce inventory, what you see on the shelf is pretty much what they have in the store. There is no backup stock. What the backup stock is, the products get delivered and they put it on the shelf overnight. There's nothing in the back. Because they're trying to reduce their inventory, and they figured out if we had a better inventory system, that if we had 40 items on the shelf, once we got down to 20, we'll place an order and they'll send a truck the next day so we could replenish it. So we don't have to keep up any emergency stock in the back. We would just have what we need for the week or for 2 weeks. So that way stores could be much more efficient with the inventory they held, and then that's less money that they have to spend and hold the inventory. If you walk into any store, and you're not like this, but I hope you become like this. It's sort of a curse though, so maybe I don't hope you become like this. But I walk into a store, say I walk into a liquor store, right? That's exciting. And I go in, and I don't walk into a liquor store and try to pick out what wine I want to drink. I start adding up all the bottles on all the shelves and trying to calculate how much inventory they needed to set the store up. How much money would they have to spend to stock and buy all that wine and all those hard liquors ahead of time to stock that store? I walk into a laundromat and I say, I wonder how much they had to spend on all these washers and dryers and coin dispensers and soap dispensers and video games to create this store. How much of an investment would I have to come up with to buy all these washers and dryers and all this equipment to actually start this business brand new? How much capital is in this laundromat? Isn't that bizarre? I think that way. I go into a clothing store. Say I go into Kohl's, or maybe Banana Republic. That's where these clothes are from. I'm too good for Kohl's now. So I go into Banana Republic. That's a joke. I go to Banana Republic and I look around and I see all the clothes on the shelves everywhere, and I think, wow, that's a lot of investment to have all those clothes, because they need to have all those multiple sizes and all those different fashions. So they're spending a lot of money to do that. So you may notice that one place you may notice this, Barnes & Noble decided reduce the amount of inventory in their store. So you see a lot more books, not on the side like this, the front. So you go down the shelves, you see a lot more books where you see the full front of the whole book, not the side like it's stacked in, because they're trying to make the store look full, but having a lot less inventory on the shelves. And in many cases, they'll keep only 1 or 2 copies of a book, and if it sells out, they'll just wait the day before it comes in, because they're trying to reduce the amount of inventory or the amount of books that they have physically in the store. So they may want to have as many titles, but they'll just have fewer copies of them, and they'll display them in a different way in the rack, so it looks like it's more full. And if you notice, a lot of Barnes & Nobles, they took away a lot of their book stock, and they have a lot of other things they're selling that are less expensive because they're trying to change their mix up a bit. But it's all in defense of reducing their inventory compared to the annual sales to increase the inventory turnover, which is something investors like because they're more efficient and they save money. Just think of that liquor store again, and if they decided that they didn't need 20 bottles of everything they carry and they want to go to 10 bottles of everything they carry, they could last a long time on sales before they have to buy any new inventory. So those would be some very profitable months as they're buying down their inventory. So as companies actually buy down and reduce their inventory, they make more profits because they're not buying new inventory to replenish it. The same thing had happened if you go to your house and you say, I'm not going to buy a new thing of food until I'm done eating all the food that's currently in the house. Right? So if you're like me and I have a whole bunch of useless food in my house that I thought was a good idea to buy at one time, yeah, it'd be nice to have 10 boxes of Kraft macaroni and cheese, or it'd be nice to have this huge 20-pound bag of rice, but then you never really eat it, go out to eat every night. If I just said, I'm just going to stay here and eat everything to my house until it's all gone, and I'm not going to eat out or buy any food from a supermarket, I'd probably save $800 a month until that food was all gone. I could finally buy new things. And I'd be a lot more careful about what I bought the next time. I wouldn't be wasteful. Okay, so let's end it here. We'll continue on Monday, and I'll talk to you then.